Hey, welcome back to the Mortgage Athlete Podcast. It's Tracy Hayes here with my my host, Tom Reber.
Morning.
It's been a little bit since we've had a show, but things have been busy.
Busy.
Especially in Tom's life.
Yep.
And we have a special guest, Stacy Blair. He has over 30 years experience in the mortgage, or nearly 30 years experience in the mortgage business. We don't want to date him there, but he's done everything from origination, operations, and servicing. And he has something he wants to tell us, which I think is groundbreaking. I know Tom's excited about it.
Yep.
So I'm going to turn it over to my guest host, Tom. Good morning.
Glad to be back, Coach. The Mortgage Athlete Podcast is such a great platform for us to kind of get out there and talk about what's happening today, what's happening tomorrow, and more importantly, learn from what's happened in the past. So, Tracy, glad to be back. Lots of things are happening. Rates are higher for longer. Boo. We haven't really seen it turn. But guess what? The money and the velocity is continuing to flow. Having some of the stuff that we have today to manufacture opportunities, enable transactions to happen, medicate the people that need money. That's what's the makers today. That is movers and shakers of the mortgage business. And I'm glad to be here. We got a great guest today with Stacy Blair. I've known Stacy since 1993. And we go back to Bank Boston Mortgage Corporation, which is amazing because that's where we both kind of grew up in the mortgage business. And we had, so I'm going to give a couple shout outs to people that you know and love, which is Joe Pickett, Hugh Harris, Mark Johnson, old Tom Palmer, some of those legends, Tommy Atkins, all those guys I want to give a shout out to because they did a lot for us.
Yeah, there was definitely a great leadership group in that, and headquartered here in Jacksonville. Many of those folks are still here. So that was a great entry into the mortgage business. Nearly 30 years ago, or over, I guess, when we say 1993.
1993, it's over, but that's okay.
Yeah.
Glad to have you here on the show today. So
Yeah.
we're looking forward to discussing some of the interesting stuff that we have on the table. Stacy, what's the latest and greatest? What do you see from the markets and rates? Give us a check.
Well, I think obviously, as we talked about, we're seeing higher for longer. This hasn't happened. I think we had gotten very accustomed over the last 30 years that while rates may pop up for a while, they would quickly come back down.
Yep.
And it would either fuel more energy into a purchase market or certainly more energy into a refinance. And now we're 2+ years where we've seen this really rapid raise in rates from where we were during COVID. And what it's created, I think, is an opportunity and something that hasn't been used in many, many years, is the ability to assume mortgages. And that's what we wanted to talk about a little bit today with a group that I've working with, and it's with pointright.com, where we actually will assist in not only finding but coaching potential buyers, sellers, and realtors into how to navigate an assumption process in today's world and take advantage of these loans that carry these rates as low as 2% up to 3.5%, 4% that were originated in that low interest rate time, and really talk about that.
So I'm going to jump off because I like to bring the color and the creativity to it. Of course. So, I mean, I love the Serengeti of opportunity.
We got to have a cup of Tom.
Got to have a cup of Tom because I bring the fire. So to climb Mount Everest, it's very, very difficult, especially if you try to go alone. If you want to increase your odds by tenfold, you hire a Sherpa. A Sherpa lives there, works there, and does it all the time. This is what withpointright.com does. It becomes your mortgage assumption Sherpa to guide your transaction, point you in the right direction, and give you the confidence to win. With that being said, that is the key when you do these. Because when you say assumption in most agents today, they kind of have a little reflex. At the end of the day, when you say I have a plan and a pathway, it becomes the wind beneath their wings, and all of a sudden now we have confidence because Tracy and I was on a show the other day, all things real estate, which is really, really cool. And one of the first questions, because I like to say we got hit with a left and a right and a left and a right, what's going on. One of the questions that they tried to trick us on with the stumper question was affordability. What are you going to do about it? And I said, we have an answer for you, and that is assumptions.
Right.
And so assumptions. So share more about the assumptions, Stacy, and how and the why, because it addressed one of the big things that we got hit with was affordability.
Well, I want to just intercede there a little bit to the need. And I think, you and I, we know these statistics are
Yep.
around about, but the percentage of loans right now that are sub 5-4%. And when it comes to that challenge of affordability,
Yes, sir.
this whole puzzle piece of assumptions could be I wouldn't say the going to resolve it all,
No.
but it is something that could start moving the pieces and get our industry moving a little
Yes,
bit
sir.
if we can iron this out.
Yes, sir.
Yeah. So rough math without getting into as you were talking about, Tracy, a high percentage of loans are less than 4% today on the outstanding mortgages. A third of the loans that were originated in 2020 and 2021 are FHA and VA loans, and those are all sub 4%.
Yeah.
So huge opportunity that we have in the marketplace. Even when we look in this 904 area, if you go to active listings right now, there are about 400 plus active listings in the Ford
Wow.
County area that are FHA and VA that were in the sweet spot of sub 4% mortgages that were originated. So, and most of those are not really advertised by the realtor or the seller to be assumable loans, and that they'll accept an assumable loan. And a lot of it goes back to what Tom said, and the reason we created this group was really to fill the void that they don't have that experienced loan originator like a Tom Reber helping them guide through this transaction. And so we really wanted to be uniquely focused on the 904.
Yep.
We also want to partner up with Tom and potentially other lenders, but Tom has some unique experience as well as some solutions that we'll talk about, because there are some nuances to FHA and VA assumptions that we need to tackle. And one of those, probably the biggest one, is the down payment. So you can't increase the loan amount like you can in a purchase. So if you are assuming a $300,000 mortgage and it's a $500,000 house, you got to come up with that difference. There's a couple of different ways that Tom can help with, but one of those is a second mortgage. And as well as you can either have the money, you can borrow against your 401k, you can borrow from the bank of mom and dad that Tom will talk about.
It's one of my
There's
favorite.
He loves the bank.
I love the bank of mom and dad.
Mom and dad. So we want to partner up and work in unison with Tom on these transactions, educate all parties about what an assumption will be. I've also worked with all the national servicers, most of them.
So
While there are hundreds of servicers of FHA and VA, there's really about 15 that control about 2/3 of the market.
Right.
And so if you have relationships with those and understand the process, you can tackle a lot.
Well, Stacy, let me ask you this. We know the answer, but so you can express to the real estate agents that might be listening or homeowners, assuming the loan, it sounds simple. Oh, no big deal. But what are they really, these servicers, prepared for this? Because they've really never had the situation like right now. There's this demand that we can break open the dam and flow, but really there's a challenge there. Can they handle this flow of this? And what is the challenge? How are these servicing departments, the manpower the women power they have to handle an assumption?
Well, I would say that's always going to be a challenge.
Yeah.
But I would say the larger ones are shifting resources from their origination groups that may not be fully deployed and pulling them over into their servicing area. It really is a new origination. It's a credit qualifying. You have to have a DE
Loan officer
underwriter.
light.
Yeah. And so those resources, most of these are very large companies. I won't say they're 100% aligned. I think there's been a lot of regulatory pressure for them to become aligned, which helps. They hate getting escalated letters, especially to some of the regulatory agencies. But that's all part of it, and it's understanding how you navigate that. There is also just, they're going to tell you one number when you call and you say, hey, how long is this going to take? They're going to throw out a number that's going to scare you.
Yeah.
Experience says that's not the real number.
They typically say 6 months.
Yeah.
Boo.
And so what happens when you say 6 months? People say, we're not doing it.
Acid reflux.
Yeah.
And so that creates this barrier. It's almost an insulation on their part to say, okay, put out a really high number, and then people go, a different direction.
Right.
So that is one of the challenges, is you have to navigate and you have to understand that. You have to understand their processes, and there isn't a loan officer per se really helping you.
No.
It's a lot of, unless you use a company like Point Right,
Right.
then you're doing this alone, and it's very difficult.
Well, I know we're gonna definitely get into details, but here's one of the common things that I hear come out is, oh, they're just making it a pain in the tail to get that 3% loan because they want you to actually go and get the current rate at 7% so they can make more money.
Demystify that.
Yeah,
Stacy.
I'll speak to that. Most of these servicers own the servicing to the loan, not the interest rate. So that loan is in a security, has to be an FHA or VA loan.
Right.
Some investor, usually a pension fund, an insurance company, some type of entity like that, has bought the interest rate. So they don't care about the interest rate.
Yeah.
What they care about is
locked in.
they get
every
X
month.
amount of dollars per month to service that loan.
Yeah.
Okay, so they don't. That part of it is not true. But what is true, though, they don't make a lot of money on an assumption from a revenue generation.
Right.
It's considered they're still living off the origination dollars that were generated when
At the beginning.
at the beginning.
Yeah.
So they're not as aligned. Now, there has been some changes with FHA and VA allowing the lender to collect more money, which makes it a little more appealing to them internally to do it. But there's still a gap there. A lot of it is that, it hasn't, to your earlier point, there hasn't been much activity in 40 years.
Yeah.
If you go back 40 years, there was a time where rates were lower.
Well, I know my in-laws.
Yes.
40 years ago did assume
Yes.
different mortgages.
There's stories like that, right? Oh, my dad sold a house or bought a house or did those things. So it was a little bit of a lost art. But you're seeing the servicers, you're seeing the numbers in the industry dramatically increase very quickly. And I think a lot of it is just the key is moving those origination resources that may not be fully deployed on one side of the house over to the other side. So these are the very large servicer lenders. So they do have that ability to do it. I think, though, the only way we as an industry fully use this is to test those boundaries, right? We got to put more loans in, force them to bring those resources, either to hire the resources or to bring them over from other areas.
Right.
We can't wait for them to staff up because they won't. Right.
Here's the thing. What withpointright.com does, it enables you to speed up the process significantly, optimize the time to get this done. And the goal is, how do we get this to a point of maybe consistently less than 60 days?
Correct.
Because I think that's palatable to the market. And the other thing that we have to look at is, once you start doing business with a servicer, all of a sudden you get, we're going to say, preferential treatment because you do it right the first time. Congratulations, the Sherpa delivers. You get to the top of Mount Everest with your assumption, and all of a sudden you're good. And now the real estate athletes out there understand what they're doing. So it's going to start with one's going to turn into four is going to turn into 16, and now we've thawed the iceberg out, and the bullet's in the chamber, and we're rolling.
And speaking with a lot of real estate agents, they've compared this to the short sale.
Yes.
After the crisis of 08, 09,
Yep.
when the market was flooded. It was very new. It's very difficult, but it got easier and easier and easier as on both sides. Not only did the real estate agents and lenders get better, the servicers got better, the investors got better, and then we figured it out.
Yeah.
Assumptions will operate a lot in those same ways. The more that we get, to Tom's point, the more we work with the servicer, the better we get. The good news is, with our company, we've already worked with a lot of them.
Yeah.
We understand what they're asking. We
So
can also translate that to the buyer, the seller, to speed the process up.
What are they asking? So we've got, like you said, a lot of agents aren't advertising that these VA or FHA loans on their listings are not, because they don't know really what's going to partake. I know I had a friend of mine, alumni brother, call me on it because he knows I'm in mortgages. He's up in the Carolinas, and he saw a VA opportunity, and actually they didn't have much equity. I said, oh, this is perfect. To assume it. I said, well, really, there's nothing I can do personally. The first thing you need to do, find out who services the mortgage, make that phone call and ask for that department, and go. What are they asking for? What are they, when they make that phone call to the servicer, or I guess really with Point Right, or is Point Right making that call?
We're making joint calls usually, and
yeah.
so we're signing up and we're operating as a authorized agent on behalf of. So we're part of all that,
right?
But the reality is, you start a mortgage process. Now, the seller has to initiate that process, so that's different, right? So you have to get the seller to say, okay, I've got a contract. I've got somebody. I call my servicer. and then there's usually paperwork that they have to initiate on the front end,
Right.
conjunction with the buyer. And then the process looks a lot like a traditional mortgage.
Yep.
Applications, credit documents. There isn't a requirement for an appraisal, so that's a big
Huge win.
Yeah.
Huge win.
no appraisal on these. But a lot of that after is going to look a lot like a mortgage. There's a title company, a closing, transfer of funds, those types of things.
So really, what are some of the things they're asking for? What is the seller? What information they need from the seller other than an authorization that?
That's the biggest part. Yeah. It's a copy of the contract. It's an authorization. It's basically them saying, I agree to this. And there are some nuances because on an FHA, a little simpler. You are, there isn't an entitlement like a VA.
Right.
So on a VA, you're agreeing that, hey, I'm a veteran and I'm selling to a non-veteran. I understand my entitlement is staying with the property. So you're acknowledging all those things. If you're selling to a VA, you acknowledge that you're looking for a substitution, of entitlement. So those are all things that are covered up front that where you're buying into as the seller. Different than the seller would never initiate that on a traditional purchase, right? You're working, and you have to work with that servicer.
Yep.
So I always talk to real estate agents, first thing, get the mortgage statement. Understand what you're dealing with, who the servicer is, what the interest rate truly is. Because consumers will tell you sometimes, I have a
Slippery
2.5%. Well, it may be 3.5.
1.5.
Well, it could be better. It could be worse.
Still good.
Still good. I thought I had a 1.5% rate, Stacy.
Yeah.
Turns out it's 4.5. Still good.
But it's just understanding exactly what you have in the transaction.
Yes,
and so you want to do that. You want to initiate it. You got to be careful, though, that you don't listen too much to what the servicer says from a timeline.
Right.
While it's, you're going to get it. You can't not get it.
Right.
You also have to understand that they're almost trying to give you the worst case scenario.
Right.
So they're almost purposely trying to say.
Well, and they don't know point rights going to be involved here,
Correct.
and that's where you're going to hopefully accelerate this.
We're going to accelerate it, and but just like with the regular mortgage, we need all parties to help us.
Right.
Right.
Collaboration.
Like, it's a collaboration. To Tom's point, we need the borrower. The buyer in this case, potential borrower when the loan's approved, when they request documentation, a lot of it's just credit documentation. Get it in.
Yeah.
We'll help. We'll explain what you need, but you still have to go get those documents and get them to the servicer as quickly as possible.
So I'm a rubber meets the road. I'm thinking our listeners right now are going, okay, let's gumpify this down a little bit, just so the real estate agent doesn't need to know how we're putting the mortgage together, whether or not they're approved, right? They're not mortgage people. We're mortgage people. They're getting that contract.
Yes.
I got a listing agent going out. The house has a VA loan or FHA loan on it. What is the first thing they want to do in that conversation with that person wanting to sell that home?
Well, first of all,
and in a sense, prepare them for this.
Are they open to an assumption?
Mm-hmm.
Right. So that's the first part. Will you entertain it? I would say at that point, that's where we would like with Point Right to help them, educate them about what the pros and cons of an assumption is in that process. And so that's where we want to be involved, is that education up front of all parties, because that's going to make it easier. If you don't understand the assumption, you potentially may go into it and say no and not understand that there's a lot of advantage. The no appraisal, we've seen where there is a value when you explain it to the seller. You have a 2.5% rate. There's a value to that.
Yeah, huge.
Huge value.
But if you're not willing to accept an assumption, you can't recognize that value. And so the way I kind of try to simplify it is, you may potentially be able to, would you sell for a lower price if it's a cash offer? Maybe. Would you sell at this price for a traditional financing offer? Yes. For an assumption, would you maybe get a little more money?
Now we're talking, Coach.
Now we're talking about not only bringing more buyers potentially, because once you advertise as an assumption,
affordability.
Yes, affordability. When people see on that MLS and those private notes that this rate, this payment, people are going to come. They're going to ask.
Well,
that drives eyeballs on the property.
As the listing agent, I think you hit it right there. It was a great analogy there of the steps. And the reality is you're going to be able to hold price. These builders are holding price because now they're giving all these incentives, and so they got the people focused on the rate because they're holding the price.
Correct.
They're not discounting the price and giving the rate.
Nope.
It's just like
One
the
or the other.
cars.
Yeah.
You can get 0% if you pay the full sticker price.
Correct.
And in this case, and when we're talking, I think on average, especially if you're looking at $500,000-$600,000 loan,
sir.
you might be talking over $1,000 a month difference.
You're definitely
Easily.
talking over $1,000 a month on that.
It's crazy numbers because when we were on the radio show and we were hit with the affordability, we have the answer for that.
Mm-hmm.
You just have to dig a smidge, and you have to figure out. All of a sudden, once you see the savings, people are now engaged. As we know, with the wonderful NAR lawsuit, August 17th, I guess, is our date when official. All roads kind of lead to the listing agent. Well, we need to educate the listing agents and say, hey, you got weapons of opportunity you may not know.
Weapons of opportunity. I like that one.
Another one at Tom is.
You need to be writing these down, Tracy.
Weapons
I've
of
got a
opportunity.
dossier that you need to give me.
But Tracy, in all seriousness, we met with a realtors just yesterday.
Yep.
And when the realtors raised her hand, she's like, I got a VA.
Yep.
She didn't really have it advertised.
Nope.
She didn't understand it. Then she had 2 listings, one FHA, one VA.
How about that?
By the evening, we had, really kind of talked and we're collaborating on those 2 deals just because of the education, right? And so there is this education not only to the realtor, but to the sellers. And now we're bringing in, we need to talk to buyers.
Yeah.
And so they're going to be doing open houses. We're going to be in there talking to all parties, helping them navigate this. And that's really where you have to have, that's the missing link in this assumption business, is having someone who truly understands this and an entity can help coach everybody and say, okay, this is what this means.
From the real estate agent's point or side of this, they need to know this is available and some basic knowledge that, hey, we can actually hold price.
Right.
They're going to save thousands plus dollars a month because this rate is so low on such a large amount of
Correct.
money. And so let's get with point right. Let's put this together. They're gonna get from what I understand, you're gonna help them obviously fill out what they need to do.
Correct.
Right.
We're also going to be working with Tom. We're going to pre-qualify all your potential buyers
Correct.
to make sure that
we don't start this process with someone who can't buy.
Exactly.
Yeah.
and really understand sourcing of down payment and, are you, occupancy is a big issue.
Big issue.
And especially on FHA, it's a no-go.
It's a no-go.
If you're not willing to occupy that property right away, there's no reason, this isn't a game to grow your real estate empire on the FHA side. On the VA side, as a non-veteran, you do have some flexibility there.
Oh, okay.
Yeah.
I didn't realize that.
Yeah.
That's interesting.
Tasty.
Yeah, that is.
So on VA, are you saying that maybe investors could possibly play in this?
Yes. If the
Newsflash.
veteran, if the veteran is willing to
part with
their
entitlement.
and leave it with that property, an investor could come in and purchase that home.
Get you
under
some
this.
of that.
Well, we're going to leave the tidbits to that into our educational seminars.
Oh,
that
I
we
like
plan
part
to
2.
have. Yes, when the agents, when our
Now, I do have to give
when
an
our agents come
appetizer
in.
on the gap. With the gap financing. We'll touch on that.
We'll get there.
So excited.
Okay, so the buyer side. So we've got agents now are advertising, hey, I've got a home with a VA loan on it.
Yep.
I got a buyer over here. What do the buyer's agents need to do? How do they get plugged into this to say, one, they go over and look at the house.
Yep.
Yeah, this is a house I want to buy. What do they need to? What's the steps they need to take next?
I think again, we're hoping to have collaboration on both sides, right?
Yeah,
So if you're a buyer's agent, again, we want you to engage point right.
Yep.
We want to help pre-qualify your customer, not only for the assumption, but just in general, right? And that's where Tom and I are working together on these. And, big deal is not only just your general qualification, like you would with a mortgage, the biggest one is that down payment, right? That gap, and how are you coming up with it? Now, the easiest scenario is I just sold a house and I have $200,000. Great. Then we just move into the mortgage piece, potentially, or the mortgage-like part of the assumption, right? If we don't have all of that, which a lot of people won't, We have second mortgage
Yep,
options.
second mortgage options.
And Tom can talk a little more.
I'll jump on. This is my favorite part. I love the money. I love the money.
He's been
I've been
chewing on it
ready.
over there. I didn't let him.
So my favorite, obviously, number one is the bank of mom and dad. The bank of mom and dad. You have to have that qualified conversation with your parents or your family of why, because most of the time it's a first-generation home buyer. And the silver tsunami of wealth that we've all been recognizing over the past probably 3 or 4 years, they have money. They can't take it with them. So why wouldn't I invest into my son or my family or my daughter to be able to invest and pick up a house and get their mortgage payment less than $2,000? And it may be a $100,000 gap, so I'm going to let them have $100,000. By the way, there's no tax implications because you have a lifetime exemption on your IRS tax return form if you wanted to use it against that.
That is a common question.
It's a huge question. And so the objections that are built in, you can solve real quick. So the Bank of Mom and Dad is a very powerful resource, but you have to have the confidence and education of understanding to have the conversation and inspire those people to talk about it. Because I have a feeling about 85% of the time, it's going to say, yes, I like that. If I'm going to invest, I'm going to invest into my family's real estate. This is why I'm going to do it. It makes perfect sense. I'll call my wealth advisor, get the money gifted over to you. We're going to make this happen. Number two, the seller. Did you know the seller is going to net, let's just say, $300,000. A good listing agent is going to say, with your funds, what are you going to do with that money? You're going to watch it sit in your money market account making 5.25%, which is pretty damn good? Or do you want to make it the gift that keeps on giving? Seller held second. Imagine sitting there taking that $300,000 gap and making $3,000 a month compounded interest for a long time. You pick your stuff, and you can source that opportunity. So you give them a low payment, you make money on that, and just inspire them to be able to get the deal.
You could. Am I correct? I mean, you could easily offer 7 or 8% and be below market on any second.
You can modify, you can change. It's a seller held second. It's a lost art from the 90s that was really popular back then, and that's where the influence. Seller held second. It's a lot more money there than you're going to make with your wealth advisor. And I love all the wealth advisors, but let's just say they're making 15% per year. Imagine making compounded interest every month, and you control that on the pixie dust that you appreciated in your house. Just say. One more thing. Number three, and this is another part that we're pretty excited about, is we actually have gap financing options.
Right.
So that gap financing option, let's say it's $100,000, we'll give you 85 cents. 85 cents on that $100,000. So technically, instead of having to come up with $100,000, you only have to come up with $15,000. So those are three great options. There's a few more, but they're there. It can be done is one of my favorite phrases. So anyway, Tracy, that's the awesome news that we have today.
Well, the great thing about the seller second is they have their own guidelines.
Yes.
They can go to 100%.
Yes.
Yeah, so that does make
it's the gift that
feasible
keeps on giving. You're getting compounded interest that most people don't realize how much that is. Let's just say it's $100,000. Let's just say it. $1,000 a month is 12%. That's $12,000 a year on $100,000. Show me an investment that's making that with one of the big houses.
Right.
Probably not.
Right.
And it's safe.
And what Tom's is really talking about, or the reason I think there has to be tight collaboration with a lender as well, right? That this is all about blended rate for the buyer.
Blended rate.
They've got to understand, okay, I'm paying this over here, I'm getting this advantage, but it still gets me in the house. Is it the right scenario? And what I see is there's a lot of mix and match, right? Most borrowers are coming with some amount of money on these assumptions. It's just how much do they want to do, either in a second or a gift or whatever those scenarios work out. So that's where a lot of the work is with the buyer. And then just navigating the approval process with the servicer. You've got to submit all those documents. You got to go into the queue for underwriting. The underwriter's going to come out with steps, just like a traditional mortgage. You've got to coordinate the closing. And, now you've got two different lenders coming to a closing. And assumptions for the title agents are typically a little nuancy there, right? Because they're not used to these as well. They're used to money coming in, and in this one, it's really only coming from the buyer, not from the lender. You're just assuming it. And
Collaboration.
So that's the reason we created With Point Right, to help navigate this and really get all parties understanding this unique opportunity. And as long as we hear rates higher for longer, this is going to, and so there is this, when we've heard people say, gosh, I missed out on getting the lowest rates ever, right, on a 30-year fix. They're still there.
Still here.
They're still there.
Yeah.
And there's still an opportunity for people to purchase into those and to actually, from a seller, transfer that value to someone else. And don't give up that 2.5% rate without at least trying this process.
And Tom, I want you to answer this question just as mortgage lender to mortgage lender here. This is, people hear the rate on the second.
Yeah.
And the term blended rate means something to us, but they're not, instead of getting one loan for $600,000 at 7% right now.
That's right.
We have a first mortgage for $500,000 at 3%.
Right.
And then the second maybe $150,000 because they are going to come up with some $150,000 as a second. Maybe that is 9-10%.
That's right. That's right.
But we're still looking, when you put the two payments together, you're still looking over at $1,000 less than you would if you had one loan at 7%.
The key thing there is, Tracy, is the creativity from the listing agent's approach to provide influence and value that everybody wins. And that is the bottom line. You can control the narrative. You can have a qualified conversation with the seller of the house, educate, basically show them the numbers and how do you want to play this? Because every buyer comes in. It's a different type of buyer. Mm-hmm. You take that buyer, you find out what their real needs are. Hey, I love the 2.75% interest rate. Great. This is what it's going to cost to medicate. This is our opportunity, and this is where we get withpointright.com, get it pre-scrubbed, know who the servicer is, know what the gap financing options are, and then attack it from a good standpoint that everybody wins. And I think the collaboration from the realtors is a huge win. Getting withpointright.com in the QB1 position to handle some of the backside stuff to make sure he's the Sherpa to go in there and plug in with the servicer. Then you get into, is the customer for real? Do you have an appetite for this? Let's get you pre-approved. Income, asset, credit brings the collateral, and then we can really figure out where the savings are. And I think that's where a great listing agent earns their fee for service and knocks it out of the park.
Right. The one thing we didn't answer, because I can imagine anyone listening right now going, well, what is point right? How, this time they say it's going to 90 days or 6 months to do it is just their standard answer.
Right.
Just to put everyone
6 months
back on their heels. And do you still want to do this? Then we'll start the process.
Yeah.
Stacy, where do you feel is going to be a convenient turn time with Point Right's assistance, and to give these agents a little more feel for what from a timing standpoint?
Yeah, so great question. I will put it a little bit vague in the answer, and this is part of the education that Tom and I have been talking about. Is every servicer is different.
Yep.
So there are servicers out there that I've seen close assumptions in 30 plus days.
Mm-hmm.
And then there's others that are 90 days. And that's with us pushing very hard.
Yep.
The industry's getting better.
Yep.
We're all getting better. I would say we're typically seeing that these things are closing in the 60-day range.
Yeah.
Your goal would be 60 days or less.
I think the goal is to get it down to 45, probably 30 to 45. I'm just saying that there is
get the standard answer.
Yes. but every servicer is different because I'm not the lender, right? Like, so Tom can sit as Planet Home Lending and say, we close in X number of days because we have those resources.
Right.
I can't necessarily say that.
Yeah.
Because if you tell me a certain servicer, I'm going to okay, that's not happening as quick as this one. If you tell me this servicer, I'll tell you based on
what are a couple of the best ones you like?
I'd rather stay away from
the
names.
that.
Good. Dodged a bullet.
But what was the number you gave earlier? There's a handful of servicers that service a majority of
there's about 15 that service about 60%
of or more of those.
Yeah. Of the Jenny Mae servicing.
I'm going to give you a little appetizer. So Stacy and I had a call with Planet Home Lending's head of servicing. And it was eye-opening in the sense that they were exactly what you described. But here's the good news. They're aware, and they know performance means something. And having collaboration with withpointright.com has significant value because it's going to be done right the first time. It's going to be one voice, QB1. You got QB1 here that's going to handle the interactions with the servicer. And guess what? The success goes up tenfold, just like being able to climb
mountains. One
mountains.
of the biggest things we bring to them is a qualified borrower.
That's right.
Because keep in mind, if you go on this by yourself a lot of times, it's not being very well vetted.
That's right.
And so what happens is people get in, we actually have a lot of people that talk to us
Yep.
and then decide to potentially go that route without the Sherpa to use.
Yep.
And halfway up the mountain, they're like, help.
Yep.
Yeah.
Can
Can
you
we
come
get the
in?
Sherpa?
And we will, certainly, but gosh, you make it a lot harder if you do that.
Yeah.
For all
Everybody.
parties. Right.
What is a typical chart if they weren't using point right, they just called them and they got the assumption. I imagine there's some sort of fee that the servicer's charging to make that process that assumption. What is what is the standard
it's
number?
typically about 900 to, I think now FHA allows them to go up to 1,800.
Okay.
9 to 18. But here's the thing,
process
Trace. There are savings, no appraisal.
Oh yeah. The
You-
upside is so there.
Yeah, so you're still paying less for the transaction than a typical mortgage. You don't have points.
Yep.
You don't have underwriting fees.
Well, the processing and underwriting from any lender is going to run in that area. anyway.
Yeah, and then also what we have found, and a lot of this is where Point Right can come in and help, is that the servicer is allowing that there isn't a new policy required for owners or lenders' title insurance.
Wow.
Oh,
That's a good time.
yeah, that's a huge savings.
That's
So
a
in
huge
certain states, Florida being one of them, where title insurance, Texas, etc., that's a huge savings.
Yeah, that's
Because the
that
original
covers
policy-
the fee right there.
Yeah.
Yeah. So you're saving quite a bit on the cost. How are we going to get this out there? Because I know Tom, you and I have talked
Yep.
about it. But someone who might be listening right now that deals a lot with it. If you're an agent that has a VA listing right now, you need to message myself, message Tom through the Facebook or wherever you see this video that you're
Yeah.
interested. I have a VA listing. Tell me more. What's kind of our plan of attack?
Well, we're going to continue the campaign of going out there and touching real estate agents and real estate offices and getting out there. We've been on a radio show. We've touched on it there. We're going to keep pushing it out as hard as we can, as fast as we can, because I think that once we break a certain level, it's going to start rushing the other direction. Right now, Stacy mentioned there's 400 properties out there. We know all 400 properties. We got to touch 400 people. So we've got to work on an email list just to get it out to them. Say, hey, we're here to help you. And I promise you, 400 or 350 of those don't know what they don't know with regards to the assumption. You may have 50 that says $399. Oh, I'm so sorry. $399. Thank you, Tracy. But this is what we're doing with Mortgage Athlete Podcast, the Real Estate Excellence Podcast, other venues and opportunities, radio. We've done all things real estate as well. A lot of great things to do. So we've got a lot of work ahead of us, but it goes in concert with a lot of other efforts with regards to affordability. In a market today, you have to manufacture opportunities. If you're a taker, you're not going to be in this business long. You have to be a maker. We have to make opportunities. We have to make opportunities for the right reasons, earn our fee for service, both mortgage and real estate, and be professionals. We can make just really great positive things happen.
And just to kind of put a human face to it, the ones I've done, it's really powerful when you are able to collaborate with all the parties.
Yep.
And get a buyer into a home, and they're saving anywhere from $1,000 to $1,200 a month.
Yep.
A month.
Yeah.
A month.
Yeah.
Over the life of that loan, and that's what we're in the business for, right?
Yeah.
Let's not forget that. That is where the rubber meets the road, and when we can put people in there and that momentum builds, then we're going to have a tremendous amount of opportunity just here in this market.
Yeah.
And so I'm really excited to be part of this. The collaboration with Tom is, I think is key to this, getting his expertise where we bring good qualified customers to the servicers. That's our value prop to the servicers, by the way, right? We're not trying to push something that isn't pretty well vetted. We know what it takes. And so when you do all those things and you present a good, solid customer, then the chances of that file being, processed timely and closing timely is multiple.
That's the 10X.
Yeah.
That's the 10X.
So, it's one of those things. You can certainly try to scale the mountain. To Tom's point,
Yep.
We know we're absolutely confident that we can help with the process tremendously, 100%. And that's where that fee is justified. And I think we can prove it time and time again. Have a conversation. Send an email from the website.
Yep.
Call me. A lot of this is just, it's really that human part that we deal with, right? Talk to people and explain the process and explain the value proposition.
With pointright.com. with pointright.com.
Yes, sir.
Actually, it's in the notes down below here on Facebook and YouTube. You can get it there. Anything you guys want to add before we conclude here?
Well, I'm going to tell you this is a game changer.
Yeah.
If you're not aware, you need to figure it out and ask questions, because this is the single biggest game changer we've had in about 40 years. It's back. We did a lot of this stuff back in the 90s, early 90s, 91, 92, 93. Back then, they were non-qualified assumptions. Today, they're qualified assumptions, which means you have to have income, asset, credit to get the collateral and the rate. The game changer is in how much you can save. Big time. So, Stacy, thank you so much for being on the show today. Any parting thoughts?
Yeah, just one thing I wanted to also just put in, I always try, it's a release of liability loan.
Yes, sir.
So the seller is getting a complete release of liability from the credit obligation.
Correct.
That's usually one of the biggest questions
Yes,
that
sir.
comes up.
Yeah. The only attachment really is a veteran selling to a non-veteran.
Right.
The only attachment is that entitlement is hung up on that.
Yes, and there's some things that we can talk about. If we talk to the veteran about some ideas, how much entitlement is left is the first one.
Yeah.
Also, the ability to petition the VA to get a full, entitlement back.
That's a secret right there. It's good.
Is there. So there's some things that we've seen work. It's not and also, too, the reality is a lot of veterans now are walking away with a lot of money
That's right.
from the sale of their home, and they may not need to pursue
They don't
a
need the
VA
VA benefit anymore.
Right.
for the
same
next
way.
home.
Right.
VA is not the cheapest loan, especially,
If you're not receiving disability, you got to pay
Yes.
that
The
funding fee again.
Yeah.
So, a lot of organizations, we've talked about this, that are veteran, the Penn Feds, the USAAs, you go into there, they do a lot of conventional business.
That's right.
And all their clients have VA.
Yeah.
So it's not 100% like if a veteran has it, they have to use it, because it does have some expense to it.
Right.
It's golden in the right opportunities.
Right.
We've all done it in our careers and help people, helps a veteran, but not 100% if you're selling your home and going for that next use is it the right program. So those are all things that we can talk about with the real estate agent, with the buyers, sellers, and talk through those things.
100%.
Great show.
Gentlemen, thank you.
Awesome.
Hopefully we'll get
Great
some
job, babe.
Yep.
rings on the phone. Any agents that are, you have a VA listing right now, I think you need to message us. We'll get with you and talk to you deeper on how to present that to your potential buyers, especially as we know this market, more and more listings are sitting.
Yes, sir.
Get those mortgage statements if
Get
you're a
those
listing.
mortgage
Number
statements.
one,
Number
mortgage
one.
statements.
Yeah, see what you got. See if first of all, you want to make sure it's FHA, VA,
Right.
what the rate is, what the balance is. Then you got, what we have, and that's where we always.
Because that's going
want
to be the
start.
first thing we're going to want to see. Is
That's
that
the first
statement.
thing when we
first
talk to a listing
Get the
agent.
mortgage
is
statement.
let's make sure we got that and got a clear kind of idea of what we're dealing with and who the servicer is. By the way,
Yeah.
That's right.
big deal.
Excellent. Thank you.